Hello, Ed Yardeni here. Thank you for joining me for our Monday conference calls, webinars, web chats, whatever you want to call them. This one is actually being pre-recorded on Friday, April 29th. My wife and I are celebrating our anniversary. And so we're going to go down to Key Biscayne, and that'll be Saturday through Tuesday. So I figured we'll take it easy on Monday and hopefully the sun will be out down there. It's supposed to be raining, but we'll have a good time. But I did want to give you some of my thoughts about the markets and the financial markets and the economy. Obviously, it was a really tough week in the stock market and the bond market. I mean, cash has been the place to be so far this year. Benefit of hindsight, preservation of capital is really the theme for the year. And that's been true in, again, both in stocks and bonds, and on a global basis as well. I think the US has clearly outperformed the rest of the world, but in terms of total returns, they got minus signs in front of them instead of positive signs. Well, 2 weeks ago, near the end of that period, Thursday and Friday, 2 weeks ago, we saw that the market had a bad spell. That was after Thursday 2 weeks ago when Fed Chair Jerome Powell turned more hawkish than ever in some remarks, and the market had a bad sell-off then. And then it's been a tough week this week. We've been mostly down. We had an up Thursday, and it looked like maybe that was making an important bottom, but that was not the case. We got up on Friday and saw that Amazon disappointed with earnings, largely because of costs. Costs are going up a lot, and there's a slowdown in web usage on Amazon. And then we got Apple's results, and they were pretty good. But the company gave some very cautious guidance about the problems they were having with supply chain disruptions. It sounded more like they were going to miss out on revenues that they would have liked to have, rather than on a situation where they were going to drastically miss out on business. In other words, they basically were saying we could do a lot more business if there wasn't the supply chain disruptions. But clearly that was upsetting. And then on Friday also, we had the GDP come out. It was down 1.4%. So we're halfway there for a recession. All we need is another negative number in the coming quarter, and I guess that officially would be a recession. But keep in mind that it was a very funky GDP number. We actually had consumption spending up 2.7% at an annual rate in the first quarter of this year. And what made it down 1.4% is that the trade deficit just blew out. We just had all-time record trade deficit as imports soared relative to exports. There's some thought that as it became increasingly likely that there could be a blow up in the Eastern Europe and Ukraine, that some companies accelerated their imports to try to shore up some of their inventories for items that might become again challenged by supply disruptions. Whatever it was, it certainly showed that the good news in terms of domestic spending, particularly consumer spending, was offset by the trade deficit. Look, a lot of this has to do with the fact that the federal government, the Fed combined with the Treasury, overstimulated the economy. That created a demand shock that has overwhelmed the supply system and caused a supply shock. If there was just something fundamentally wrong with the supply system, if it just kind of suddenly out of the blue broke down, then we wouldn't see record imports. But that's the story. We've got record imports coming into the US. So clearly there's lots that's getting through in the supply chains. It's just the demand just overwhelmed them. And of course, that in turn led to this tremendous pickup in inflation that we've seen over the past year, really since March of last year, when the CPI went above 2%, and now we're at roughly at 8.5%. And you saw the consumption deflator is also up there, and sort of 6 to 7% range. So that clearly spooked everybody. And then the employment cost index came out, and it wasn't a surprise, but it just reminded everybody that we've got a wage price spiral going on. So all that pushed the bond yield up, pushed the 2-year yield up, reminded everybody that the Fed hasn't even really started to tighten yet. All they've done is 25 basis points so far, but they've certainly managed to talk the stock market down and to talk bond yields up. And so the tightening effect of their policies has already kind of been front end loaded by what they've done to the financial markets. But we'll see how the markets react to them actually moving. Maybe the markets will buy on that news to the extent that they've been selling off weak all along here because of the increasingly hawkish talk of the Fed. The S&P 500 is on Friday made a new low for the year, so we're down now 13.9% from the January 3rd high, record high of this year, and that's still correction territory. I know for a lot of you it doesn't feel that way, because in order for it to be just down 13.9%, you had to at least market weight energy. So you had overweighting energy obviously was the right thing to do with the benefit of hindsight, but even energy recently has been somewhat weaker. But all in all, we're still in correction territory. That's not the case for some sectors of the S&P 500, and it's certainly not the case for the Nasdaq, which is basically in a bear market right now. So where do we go from here? Well, let's look at some charts and see what the charts show us in terms of some of these points I've been making. First of all, let's talk about the big leak, as I like to call it. The big leak is the idea that all this amazing monetary and fiscal stimulus that has caused a V-shaped recovery in the U.S. economy, some of that stimulus was leaked overseas through greater imports. And here in figure 1, you can see that in nominal and real terms, well, this is nominal terms, you can see this huge increase in imports, an all-time record high. It's not as impressive in real terms because the reality is inflation is a global phenomenon. And now instead of importing low inflation, we're importing high inflation from a lot of places. And that's even though the dollar has been very strong, which we'll discuss in a minute. This is the export side of the equation, which really isn't all that significant to the story, other than to point out that, as we all know, we import a lot more than we export. And so what matters is the net merchandise trade deficit, and it's at an all-time record high. Let's look at the chart here on the growth rate of imports and exports. Again, you can see monster increases here in imports, up 25.6%, exports up 18.1%, and a good part of that is inflation on both those series. Here's the inflation numbers, imports and export price deflators. As you can see, export prices are up 14.7% and imports are up 10.4%. When we look at the merchandise imports by categories and just focus on the current dollar items, as you saw before, the total has gone kind of straight up, and so have the components, the consumer goods, ex autos, capital goods, ex autos, and industrial materials have all gone up substantially. This, by the way, is auto vehicle parts and engines, it's imports. And it's kind of interesting to see that, at least in current dollars, it's back to previous highs. If it wasn't for inflation, the conclusion would be that the foreign automakers are clearly finding the parts they need to produce cars to export to the US. But some of this is, of course, price increases. But I think there are some other signs out there that some of the parts issues that have been creating a problem for the automakers the problems are abating somewhat. Now, one of the things that's really kind of interesting here is we have a record trade deficit. Imports well exceed exports, and yet the dollar has been remarkably strong here. Now, the only way that can happen is if capital inflows are at least more than offsetting the widening trade deficit. And sure enough, there's some data that I'll show you in a second. I want to skip to it. Let's skip this one. Let's look at this one for one quick second here. Just making the point that when real GDP came out, we saw that real GDP was down 1.4%, as I said. And the big contributor to why it was negative is because we simply, on a net balance, had a record net exports of goods and services, a record negative deficit. And as a result of that, one has to wonder how it is that the dollar has been strong. And the only answer can be that capital inflows, net capital inflows, are offsetting that. And sure enough, if you look at the current dollar, this is actually the inflation-adjusted trade deficit. If you look at the current dollar deficit, it's actually $1.2 trillion. So keep that in mind, $1.2 trillion record current dollar export, net export deficit, and that's in current dollars. I'm thinking current accounts and current dollars. I'm tripping myself up here a little bit. I'm starting to sound like Joe Biden. Anyways, figure 9 shows a monthly series that comes out from the Treasury International Capital. It's called TIC. And as you can see, that's just gone straight up. And it's fascinating that it's at an all-time record high over the past 12 months. We're looking at something like $1.4 trillion in net capital inflows. And that's really before Ukraine hit the fan. I mean, that's clearly not all of that happened from February 24th to the end of that month. So it's very likely that we're going to continue to see that this continues to move higher. I think what this reflects is that global investors increasingly perceive that the U.S. is a safe haven in this very turbulent global world we live in. So the money just keeps coming to the U.S. and more than offsetting the trade deficit. So the dollar has been really remarkably strong, as I showed before. Now back to the economy. Again, consumer spending in real terms and real GDP was up 2.7% during the first quarter. I'm having a tough time really seeing that in my charts, but it is what it is. First of all, let's start out with personal income. Personal income all in total is what this chart is all about. These are the spikes when the government provided helicopter money, provided checks, and so that stimulated more spending and boosted personal income. We've never had a situation in a recession, which was this 2-month event here, where personal income actually went up, but it went up because of the government support. This is inflation-adjusted version of this indicator. And as you can see, we're not doing that great for total real personal income. Well, maybe we should just forget about government social benefits and just focus on what people are actually earning. And that looks pretty good. In March, it was very strong. But again, adjusting for inflation since March, this is where you're getting kind of a 2.7% increase when you look at the first quarter versus the fourth quarter of last year. So there's still growth in the consumer, and 2.7% is respectable growth by the consumer. But let's see what the prospects are for the consumer spending. And here's the total spending. Looks great. But again, adjusted for inflation, not quite as great. And when you look at goods, the goods adjusted for inflation has actually been flat. Now, that's not too shabby a performance when you look at the fact that we're talking about a record high in the in consumption of goods. But it is flat, and it's probably going to remain flat, maybe even come down some, because let's face it, there's probably a lot of pent-up demand that's been satiated here. The one thing that's missing is auto sales, and maybe if the auto industry gets its act together with parts and so on, we'll see better auto sales, and that'll help on the goods side. But then I think we can continue to count on services. Notice the goods all-time record high, but services in real terms are still below their previous high, record high before the pandemic. So there's still upside there. People still have cabin fever. That maybe they satisfied some of that cabin fever by going shopping for goods, but I think the services side of the economy now is going to get more of a lift. So I don't think there's going to be a consumer-led recession here. I think the consumer is still in pretty good shape, has the will and the means to spend. Certainly, real the employment numbers are very strong, and wages are rising just a little bit faster than prices, but it's a stagflationary environment. Doesn't mean that there's no growth in the economy. I think there's about 2% growth, and I think that's where it's going to trend. So I wasn't too concerned about the negative 1.4% growth in the fourth quarter. Let's talk some more about inflation, because obviously that's the key issue here. And we've been doing a lot of work on inflation because we viewed it as a key issue. And you can see here the consumption deflator came out. The headline was 6.6%. The core is 5.2%. On the headline basis, we're shooting for a range of 6 to 7%. So 6 to 7% as being the range in the first half of the year. Then we're expecting it to moderate to 4 to 5% by the second half of the year, and 3 to 4% next year. We don't think it's going to take a recession to do that, but clearly that's becoming an increasingly contrary view. People are becoming more and more pessimistic and coming to the conclusion that the Fed will do that consciously, cause a recession to bring inflation down, or just make a mistake, policy error, just get too tight with an economy that's slowing, and that will cause a recession. Recessions always bring inflation down. That's for sure. But as I said, soft landing scenarios are becoming scarcer and scarcer, I think. We're still there, though, with a 30% risk of a recession. Again, this is a chart of the consumer price index, year-over-year percent change. And as you can see, look at it closely in your leisure, and you'll see that, in fact, inflation does come down during recessions. But take another look at this chart, and what you see is that, I've been thinking, it's like, wait, why is the bond yield at 3% when inflation is running 5, 6, 7%, depending which measure you're looking at? Why aren't we up there already? Why would people want to buy a bond at 3%, knowing that it's a negative real rate? Well, what they don't know is how long inflation is going to stay that high, and maybe they have a subliminal, subconscious historical view of inflation. And you can see that you typically don't see inflation staying high for very long. You get these spikes. We had the spike here during World War II. We had a spike here coming out of World War II. We had a spike here around the Korean War, another spike, and it came down. This is the concern, obviously. The great inflation of the 1970s actually started in 1965, and you can see that it picked up, then it came down, but you never really kind of got that spike that went up and then kind of came back down to a very low level. Instead, it kind of came down, and then there was another one. But maybe this would have come down if it wasn't for the second oil shock. But benefit of hindsight, a lot of people back here thought this inflation were just embedded in the system. You'd never get it out. And Volcker demonstrated all you need to do is have a recession, and you could bring inflation out pretty quickly. And the Fed would love to sort of have a repeat scenario here of this particular period when, let's see, I think we're talking about this period where there was, when inflation moderated. This is their view of kind of this soft landing scenario where inflation remained moderated without a recession. And maybe that's wishful thinking, but I do think, as I've said before, that consumer durables, I'm going to skip that chart. I do think that consumer durables has been one of the main sources of this inflation. As you can see, this is the CPI and the PCED. So again, 8.6% for the CPI and 6.6% for the PCED. And look at the durable goods, 17.4 for the CPI and 10.2. That's quite a difference. And the PCED is widely viewed as a more realistic assessment of the inflation that people are facing. Well, let's get excited here a little bit. Let's put a magnifying glass onto this little thing, and maybe that's the peak. Used car prices, new car prices, the pace of increases are starting to moderate. Same thing for furniture. On the other hand, appliances is still a problem, but this should start to moderate here pretty quickly. And if the symmetry of this thing works out, then we could see some moderation in consumer durables. As I've said before, the problem with that story is the rent inflation is going to continue to pick up. And in the morning briefing, I discuss the issues there. We are in fact seeing on a 3-month basis a pickup in the inflation rate at an annual rate for rents. So rents is a problem, but that doesn't mean we can't get down to 3 to 4%. It just means we're not going to get down to 2% because rent inflation is going to be an issue. Here's, I guess I like this chart so much just because it gives me some reason to be hopeful, at least, that maybe we're making a peak here in at least this component of inflation, and that'll be worth watching. I mean, look at this. We have had a fairly long history since the mid 1990s where this was deflating. And now all of a sudden it's going up in double digits. And I think that's going to start to moderate. This is the rent story. I mentioned, if you look at the 3-month change in primary residence rent, which is tenant rent, it's 6.2%. So it's actually the 3-month is picking up and the yearly percent change is 4.4. So this is leading to even higher comparisons on a year-over-year basis. And then owner's equivalent rent obviously is affected by that. Again, looking for a peak, not finding too much evidence there. This is really not a peak. This is prices paid and prices received indexes based on the 5 regional surveys conducted by the Federal Reserve banks. And this is the diffusion index. So this is not encouraging. This is just telling us that when the companies are asked about prices, you're still seeing a record level of them saying that prices paid and prices received are highly elevated, actually at record levels. Then there is a little bit of good news here in the regional unfilled orders or delivery times. This is the sort of a proxy for supply chain disruptions. And as you can see, this we had a lot of disruptions here, and now they seem to be simmering down. So that could be an important development in easing some of the inflationary pressures. So that's it. We're not going to have a Q&A session because I pre-recorded this. I'm looking forward to getting away for a long weekend with my wife to celebrate our anniversary. We hear it's going to be raining on Saturday down in Key Biscayne, but nicer weather after that. So we're looking forward to that. Do a little sightseeing down in Florida. Not planning on buying any houses down there where we've heard that home prices are up 50 to 100%, and not planning on renting anything where we've heard that rents are up 50%. Miami is a bit of an outlier, but it's not that far out of kilter with the inflationary pressures we've seen all around the country. So have a good week. I'm hopeful that we're going to try to make a bottom here in the market. I don't think there's going to be a second leg down, but I thought we'd find some support at around 4,200, and it looked like we were doing that on Thursday and Wednesday and Thursday. Thursday we kind of Wednesday we fell below the 6,200, then we 4,200, and then we bounced off of that on Thursday, and then Friday, boom, kind of came right back down, well below 4,200. Let's try to see if we can find some support here around 4,000. I think there's a good chance we will. I mean, let's face it, a lot of pessimism in the market. Sentiment is extremely negative. The bad news on the technology front, all the disappointments have clearly been aired, especially with the mega cap 8. So I think there are going to be buyers coming in here to support this market because the outlook, I think, is actually still fairly bright. I'm not in the recession camp, and I am in the camp that believes that inflation is going to be higher for longer. But I do think we'll see a peak within the next few months and start to moderate, and that'll matter a lot to the markets. And by the way, the Fed has already talked the markets into tightening, both in terms of what we've seen PEs do and what we've seen bond yields do. So once they actually start to tighten, it's pretty well priced in the market. So again, all the best for the week, and let's do this again next week live.